Hello and welcome to the Association Essentials Series. I'm Ryan Wimmer, the Vice President of Community Management, and with me is Neil Schiffman, Senior Community Manager here at FCS. We're super excited to speak with you guys today. As a reminder, all of our previously recorded sessions are available on HOALiving.com/AES, or you can go to the website, hover over training, click Association Essentials Series, and then click previous session recordings. One more announcement is that Max Maintenance is the sponsor for this. If your boards need assistance, get those work orders in, mention this ad, get that 10% off for the scorching summer deal.
Awesome. Thanks, Ryan. So today we're going to be going over the Financials 101, going over some basics of financial management for your association. So one of the first things that we're going to be looking at is budget planning, budget preparation, getting that ready each year. So what are the steps for budget planning? What does budget planning look like? How does that function for an HOA? The first thing to remember is that your budget is a tool. It does not limit the board's flexibility to adjust planned expenses as conditions change. So when you're preparing your budget, there's really two options that you have. There's historical trend budgeting, and that means looking at a particular line item over a period of time, say 3 to 5 years, and identifying whether there is a trend of increasing or decreasing expenses that might help forecast that line item. It's a helpful way to look at utility costs and building repairs, for example. The other option is zero-based budgeting, and that means setting every line on your budget to zero and justifying each dollar budgeted. An example would be asking your service contractors what they plan to charge for their services. Most budget committees and board members find that successful budgets are developed using a combination of historical trend and zero-based budgeting. So let's discuss the steps of successful budgeting. One of the first steps is planning. So as you're putting your plan together, it really helps with an annual management plan of what you hope to accomplish in a given year. This is a list of goals the board wants to accomplish in the coming year and the individual tasks that are needed to make those goals a reality. So one of the first steps, write your goals as broad statements, preferably in sentence form for clarity. Then identify the tasks that will lead to accomplishment of each goal. For example, a goal could be, we will increase communication to the members in order to build greater trust between the board and the membership. The tasks assigned to the goal might include increase the frequency of the newsletter from quarterly to monthly, distribute the newsletter by email whenever possible, establish 2 open forum town hall meetings annually to allow members to ask questions. Once you have identified your goals and tasks, separate your needs, mandatory, from your wants, discretionary, and prioritize them. For example, you may decide to purchase a new pool cover or refresh the mulch in the flower beds at the entrance of the community. If possible, identify your goals associated tasks by month. For example, write a request for proposal by January 30th for the pool cover. Solicit bids in February and select the contractor in March.
All right, budget process stage 2, gather information. So once you finalize your annual goals, you sat down, you made all your plans, you typed everything out into sentences, you're ready to gather and review the information regarding the expenses that you're going to have. The information is easier and more accurate if you gather it in advance and are ready to go. So your primary resources for these financials, for this are your financial statements, your income and expense, your check register, your balance sheet, which tells you where you are, right now. Your reserve study. Is my reserve study up to date? Do I need to go get that redone? What projects are coming down the road that need to be addressed? And do we have enough saved? Current inflation, because inflation, right, went from standard to it's going to get a lot worse. And I think that we need to keep that as a reality when we're looking at our budgets. Current and potential service contracts, and then miscellaneous budget information. Perfect. So some of these financial statements are that we listed, they provide that economic information and enable a board to monitor financial activity. The balance sheet is a statement that reflects the financial status of the association at a specific time, which is the date that the report has been run. A balance sheet lists all the assets, liabilities, and fund balance. Assets include cash, checking accounts, saving accounts, investment accounts, accounts receivable, which are assessments that owners owe and have not yet paid. The fixed assets, so personal property that the board has the power to sell. Not a lot of boards have that in the state, at least in my experience, there are a few. So if you have those fixed assets, that's something you need to consider. Prepaid expenses, such as prepaid insurance premiums. Liabilities, those include accounts payable, invoices that you've received but haven't paid yet. Accrued expenses, expenses incurred but for which a bill that has not been received. Assessments received before they were due. Don't want to spend that money in the wrong month. The fund balance is the difference between your assets and your liabilities. One quote that we wanted to bring up was from Robert Nordland. He's the founder and CEO of Association Reserves. This relates to the Champlain Towers South. This is regarding the Surfside condos in Florida, where the tragedy occurred. And it's become something that's on the forefront of our mind and needs to be on the forefront of all board members' minds. Deterioration is constant. Deterioration is expensive. Deterioration is predictable. And so the board should be setting aside funds on an ongoing basis to offset that deterioration. This was an NPR article. If you want to look it up, you can just look up NPR Surfside condos and you should be able to find this article that was run. It is the responsibility of each board to take their fiduciary duties seriously and understand the gravity of maintaining the association's common areas. So with that, we're going to discuss reserve studies. A reserve study is an in-depth evaluation of a property's physical components and an analysis of the cost and time frame for anticipated replacements or major repairs to common area elements, such as parking lots, playgrounds, pools, walkways, lighting, and roofs. Review the latest reserve study. Reviewing that reserve study is a crucial step in determining upcoming planned capital expenses. The board will need to ask themselves, is it time to update the reserve study as part of preparation for the upcoming year's operating budget? These statutes for the state of Utah, this can vary from state to state, but for the state of Utah, our state requires that there is a update that takes place every 3 years if something major changes or if you've done any work on it. And then a completely redone reserve study every 6 years. This is to keep those numbers fresh, and it makes sense, right? These things go out of date with inflation changing. That's going to change the numbers in the coming years. You also need to ask yourself, are contributions to the reserve account on track, or do we need to make adjustments? This information is a key factor in determining your assessments.
Yeah, I just wanted to jump in here. The reserve study really is a great tool when you're putting your budget together, and it's something to help you forecast what is anticipated to be maintained over time, right? But that is something, when they say it needs to be updated every 3 years, that's something you really do need to follow as closely as possible, because we have issues like we're having this year with the incredible inflation, not unprecedented inflation, but just larger than normal inflation. Then you have issues with material costs, lumber being just exorbitantly expensive right now, labor being more expensive than normal. And so updating those numbers and getting an accurate look will really be helpful. A couple of chats are coming in about various topics. We are going to have a Q&A session at the end. And so we're trying to answer relevant questions to the topics we're going through. We're trying to hit all these together, but somebody asked, what's the difference between a 3-year and 6-year update? So 6-year update, the reserve analyst is going to come on site. He's going to evaluate all of the components of the association. The 3-year update is more of a math update on what the numbers look like, what the costs are going to look like, forecasting out towards the end of that reserve study. But yes, reserve studies are really important, and we're actually going to be doing an Association Essentials series specific to reserve studies next month on, correct me if I'm wrong, Ryan, August 22nd.
24th.
24th.
Yep, Tuesday, August 24th. Perfect. Thank you so much, Neil. And we will get to your questions. I do see them coming in. We'll cover the material, and then we're happy to go back. I've seen a few come in about insurance, and no stress. We will come back to that. All right. The third category of information to gather is your service contracts, both existing and potential. Check existing service contracts for terms and specifications, research renewal rates, or make inquiries with new service providers. Once you've gathered that information, the cost of services, add these to your spreadsheet of expenses. So you're not just getting these numbers and leaving them anywhere. You're trying to put them all into one spreadsheet as you're preparing your budget, so that you have this information relevant to your association. And I know that as a manager, I've done this myself in past management companies as well as this management company. We try to gather that as soon as possible. We start right at the beginning. If we know that insurance is going up, trust me, there's a note somewhere in your budget for this year, for next year, that insurance has already increased, and we need to anticipate that for the next year. These are things that as board members you want to pay attention to as well. Don't get into a habit of rebidding services every year in the hopes of getting a lower bid. The board must weigh the value of establishing a long-term relationship with a service provider versus obtaining the lowest price. Starting over with the new provider is atrocious. I don't know how many of you are going through this right now. Every time I've managed an association and they've switched landscape providers, there's a level of growing pains that I can't even begin to describe, and everybody's feeling it and everybody sees it. But there is some value to making sure that you've established a long-term relationship with a vendor. I know I had a community that would switch every year, and their landscaping was always just not in a good state. And then I'd have another that would come to me and say, hey, we don't like this. Let's do a long-term service contract. And we were able to develop a relationship and rapport with that landscape service contract. And they would come out, service the property. When there were issues, we learned to work with one another in a way that we wouldn't have been able to if we continued to just switch with people year after year. So there's definitely some benefits, and it's something that you need to pay attention to as a board, and understand bidding takes so much time. So really, if you don't need to do it, is there a reason to continue with that?
Yeah, getting that established relationship with your vendors, especially the maintenance vendors who are taking care of snow removal, your pool, your landscaping, them learning the intricacies of those systems is incredibly valuable. And so just making a change to make a change, or because of frustrations after just 1 year, really is not going to get you the desired results that you're looking for. Try to avoid low bids. You're getting what you're paying for. And when somebody is an anomaly on the low end or the high end, chances are they don't quite understand the scope of what is being bid.
Because we always get to that point where you get that new landscape vendor and, do you know where the turn on is? Where's that stop and waste? Where's those valves? We got a leak over here. I don't know how to turn this off. Ugh. Growing pains, learning curve, all of it. It hurts. So keep that in mind. You also want to avoid that I know a guy situation, right? So don't be hiring friends. All the insurances and everything that goes into that. There's just too much. All right, last but not least, we have a category of information that, for a lack of a better term, is called miscellaneous. This reflects various issues that could impact next year's budget. Things that you literally have no control over. Like, hey, those utilities are going up, that insurance is going up, all that stuff. You can shop for new insurance, right? But it doesn't mean that you're always going to get that lower price. And we've seen year after year, insurance companies are just going up. New building code requirements for sprinkler systems could be an example. Changes in the local state statutes on building signage. I did have that, a monument that was removed in a community. And then we found out that we were no longer able to put a new monument in after they had updated the code for the community, for the city. So that community took their sign out and never was able to get their sign back in. It was a bit of a bummer. Other examples might be updates to the Americans with Disabilities Act. That's something we have no control over, but we have to comply to. So we recommend creating a file folder that you can add all of this information into as years go by, as time goes by, to make sure that you're able to pay attention to the changes in the laws, to make sure that you're paying attention to the building code practices, the utility notices that you get. Most of the time you get those notices in the mail and you're like, ah, man, that's going up, but it doesn't go to the owners if it's coming to the association. So we will track that information. All right, budget process, stage 3, review revenue. So the primary sources of income for an association are assessments, obviously, and interest from assessments. While it might be tempting to make late fees and penalties a separate line item, this isn't a good idea. You're sending a message to owners that they need to misbehave in order for the association to balance the budget. Some associations actively pursue other sources of income to help cover the bottom line without adding any additional financial burden on the owners. Some of those disadvantages to using alternative sources of income: renting out a clubhouse, like a third-party group that comes out, that could speed up the use, the normal wear and tear on carpet and other furnishings, and could increase your insurance exposure. It requires additional administrative expense. I had a community that wanted to change their clubhouse to a facility that did wedding rentals and other types of events. This would drastically have changed if they had made that change, which they didn't. Their insurance, the wear and tear on the building was already fairly minimal, and then with that added in, we would have had to have jacked the expenses up, unfortunately. And then changes that requirements for the ADA compliance when it becomes a business, which it essentially was. Cell phone towers. Sometimes associations want to enter into an agreement with a cell phone company to install a tower. So 10 to 30-year contracts that have continuation clauses, they're no small feat. They are a challenge to deal with. You need to have legal counsel review that. And then you got to talk about maintenance and replacement. Say it's attached to the top of your high rise. That's going to have some considerations for the way that it's mounted to the building. Is that going to cause penetrations into the building and water to ingress? Things that you have to consider. Always have your legal counsel review something of that gravity. Make sure that your owners are involved. The bottom line here is that you need to carefully examine the trade-offs for some of these different ways to bring in money. Review any stipulations regarding alternate revenue generation in your governing documents. Then do what works best for your association. Something else to consider is that because most of us, if not all of us, have a nonprofit organization set up under the association's name, alternate income is going to show as income that isn't offset by assessments. Maybe some of it is, but you will be taxed. And it's not a light tax for nonprofit organizations. So something to consider there.
Awesome. So just point of clarification, most, and I think this is handled maybe in chat, most associations are not subject to ADA, but it is a potential ramification of choosing to try to look at those additional revenue streams. You know, you want to open up your pool for swimming lessons or something like that. then you have to start complying with some of those additional federal codes and state codes and things like that. So just be aware when you're looking at those additional revenue streams of some of those complications. I know this is a pretty common term that we love to use. Consult your attorney. They're going to be an invaluable resource when you're looking at some of your additional options other than just the traditional collection of assessments and investments. So now let's look at setting assessments. You've got some information, you're ready to go, you understand what the needs of your association are. And so the next thing that you're going to be looking at, Ryan, can you click to the next
Try it again.
There we go.
There you go.
Oh, awesome. Technical difficulties are always so much fun. So regular assessments, those are determined on an annual basis based on the needs of your association. They might be payable monthly, quarterly, annually, or in whatever manner the governing documents specify. They're usually calculated in one of two ways, as indicated by the governing documents. By percentage of ownership, based on the square footage the owner's unit occupies, or by equal share, the same amount for all owners, regardless of square footage. So everybody's going to have a uniform equal assessment, or it's going to be, they call it undivided interest or par value. Each unit has a percentage interest in that association, and they're going to pay their assessment based on that calculation. The other assessment option are special assessments. Those are one-time fees. They are used to cover non-routine or unbudgeted operating or reserve expenditures that cannot wait to be budgeted for in the next fiscal year, such as roofs being damaged in a storm. Because special assessments are considered extra fees, they can be unpopular with owners. Many associations try to avoid levying them and do so only as a last resort. Board members who levy special assessments, either for routine maintenance or on a frequent basis, are not properly managing the association's revenue and expenses.
Oh, I got a story here, Neil. Oh, buddy. I managed a place not too long ago, probably 5 or 6 years ago, that we took them over. I was looking at their bank accounts and I'm going, how do you guys only have $2,000 in your account? And the board president turned to me and said, oh yeah, no, we do a special assessment every single year. The owners had become accustomed to getting special assessed annually, that they were happy with low dues, but wanted to have a special assessment for anything that might pop up. That gave me a heart attack, because when we ran their reserve study, because they hadn't had one completed, and we had just taken them over, right? So we get that reviewed, we take a look, and ooh, $400,000 and stuff to do. And they don't have any money. They barely covered their operating expenses. It definitely gave me some heartburn. So I just wanted to share, don't do that.
Yeah, absolutely. Special assessment really should not be used to pay for an expense that's known or expected, but not budgeted for. So you know whether, if the association maintains the roofs in this example, you know that those roofs have an expected lifespan, and you should be preparing, hey, in 20, 25 years, we know that we're going to need to be replacing these roofs. Let's start preparing now to make sure that that happens. But then storms occur, right? Last year, we had that massive windstorm that affected North Salt Lake and into Davis County. That would have been a situation where it might have been appropriate to do a special assessment to take care of some of the maintenance needs of those buildings that were affected. So just keep that in mind as you're looking at special assessments and assessment options. The next thing you're going to want to do is compare expenses to revenue. That's the most common and generally accepted way to set assessments. However, that's not always the case. Some boards refuse to increase assessments due to some common traps, including things like, hey, our owners can't afford an increase, they're on fixed incomes. Well, our board doesn't want to look like the bad guys. That's not what our legacy wants to be. We don't agree with the reserve study. We don't think that things are going to cost this much when it's time to fix them or replace them. And I personally can't afford an increase right now. I just lost my job. The shortfall caused by not increasing assessments might be covered temporarily by risky strategies, such as not transferring all or a portion of the budgeted amount from the operating to the reserve account, deferring maintenance or deferring payments and creating debt. The association can limp through this financial quagmire for a period, but reality eventually intervenes and corrective measures such as special assessments have to be taken. So what's the problem with these strategies? The real problem is that owners buy and sell their homes. So when assessments don't bring in sufficient funds to pay expenses and fund reserves, the former owners get a free pass. They didn't pay to eventually replace that roof, to take care of the siding, to fix the pool down the road. The new owners are the ones that end up being burdened with more than their fair share. So if an increase in assessments is unappealing, two financially sound options are find other sources of revenue, as we discussed earlier, or cut costs by reducing discretionary spending. For example, newsletters are critical to engaging residents. We understand that. Building a sense of community, keeping them informed about their community's operations, very, very vital to have a newsletter to give owners an update on what's going on in the community. But printing, delivery, postage costs, those can be really expensive. So an alternative, the board could deliver the information electronically through its website or blast emails. Neither of these options may be popular. I know a lot of people just love those printed newsletters, but the board of directors really just needs to keep the association's best interest in mind and exercise sound judgment. In some cases, that may even mean that the board must simply bite the bullet and put forth a proposed budget that includes an assessment increase despite popular sentiment.
All right. I do see some more chat items coming in. I want to pay attention to a little bit of what Neil's saying at the same time. So I apologize that we're not answering those while one of us is kind of flipping back and forth here. We do see your questions and we will definitely answer them. We're going to jump into collecting assessments. All right, so the board has a fiduciary duty to the association that includes the timely collection of assessments. One of those tools used in this duty is the collection policy. Part of that collection policy falls under this hierarchy of authorities. So this is a reminder that we have that authority. Collection policy would be at the very top of this arch. And it's used to clarify the authority to collect assessments, basically. And what you're trying to do is build a schedule of when those assessments need to come in by, or what actions or consequences will be there. And that typically can be outlined in your CC&Rs, but it's better to have a very clear, direct roadmap of what that looks like. This slide actually references back to the Association Essentials series on governing documents that we held back on June 22nd. And that is also available on our website. All right, this breakdown is to show you the association has the authority to collect assessments through federal, state laws, as well as the governing documents. And the governing documents are really going to be where much of your authority comes from, as far as how and when those things get collected. So we're going to dive into collection policies. Go ahead, Neil.
Another one of my favorite parts of financial management of an association is having a really good collection policy. So, excuse me, consistent policy enforcement really is the best practice. Having that policy in place, going through the process with every single owner who's delinquent is essential to helping manage your association's financials. Oh, wrong direction, sorry about that. So a written collection policy is not intended to punish homeowners. It's really there to protect them against those who don't pay their assessments on time. When an owner fails to pay or delays in paying, the rest of the association is impacted negatively. Repeated occurrences compound the problem. For example, essential maintenance may have to be deferred due to lack of funds. Shortfalls may have to be added to next year's operating budget if monies are outstanding at the year's end. Special assessments may have to be levied, and it causes disharmony among neighbors. They see that amount, that accounts receivable amount on that balance sheet, and they get frustrated. Well, why aren't people paying their assessments? Well, a written policy serves to educate owners about their legal obligations as members of the association and what actions will be taken if they fail to pay assessments. In accordance with the governing documents, practice shows that if owners are provided this information in writing, they're more likely to pay promptly. Furthermore, a written collection policy serves as a roadmap to guide board members in handling collection activities predictably and in a sequential step-by-step manner, enforcing the policy consistently and uniformly to avoid claims of discrimination.
Wait, but Neil, can't we just send this to the attorney? This guy never pays on time. Can't we just?
That owner's the worst. They never pay on time. They do this every single year. Let's just skip all these steps and send them right to the attorney. That's an excellent way for them to say, hey, this association is discriminating against me because everybody else in this community gets all kinds of extra chances to pay. It can be frustrating for those repeat owners who are repeatedly delinquent, but seriously, go through the process. That is the best practice.
And speaking as somebody who's been to court to talk about this exact issue, where we were able to prove, hey, we followed our collection policy, no discrimination happened here, and the judge said, right on, sorry, pay your assessments. It felt really good.
Yeah, absolutely. You just really want to have these policies in place because not only, right, we talked about it protecting owners from those who are not paying, it protects the association. If unfortunately it does end up going all the way to court, you can present that document and say, here, look, here's our collection policy. This is the history of the various accounts that are in various steps of this collection process, and we follow this uniformly. That goes a long way of showing the judge that, hey, look, they're just trying to be a good business operating and making sure that they're taking care of what needs to be taken care of. All right. So again, our recommendations: make an informed plan. Have a plan of what you want to accomplish during a given year. Consider options to meet those needs. Are there some other revenue options that you can look at? Have you weighed those? Are you confident in kind of the ramifications of what that's going to mean to your association? Communicate those changes. One of the really effective things that I like some of my associations to do, especially when they've got those unpopular increases that need to be done, is they publish a budget explanation letter and they say, hey, look, this is what we've done. We've put out to bid for various services. We've looked at cost cutting, but we really can't defer this maintenance any further. And this comes in, I think one of the chats asked, hey, how do you deal with the mentality of homeowners that don't want to increase monthly assessments because they think of it as prepaying for expenses that they won't be here to benefit from? An explanation like that is really helpful to say, hey, look, we understand that you may only live here for 5 or 10 years, but it's part of your responsibility as an owner in an HOA that in 25 years, when it's time to sell, when it's time to replace that roof, the funds are going to be there. We are seeing on our end, on the management side, potential buyers are becoming a lot more savvy. They're wanting to look at those reserve funds. They're wanting to look at those reserve studies and say, hey, look, this is a healthy association. You know, they're 70, 80, 90% funded. That means that down the road, the chances of a special assessment is unlikely. This is somewhere where I want to buy. When they see that, oh, we are 10, 15, 20% funded, they know that a special assessment is coming down the line because they understand that that's going to be one of their responsibilities. And then enforce. Make sure that you are collecting your assessments. Make sure that you're getting those things taken care of with a written policy. So new chat coming in. Do we have templates for written policies for assessments? Yeah, our managers can absolutely help you put together a collection policy. And then maybe a personal issue of not having assessments increase regularly. If you are new on the board, that's one of your fiduciary duties, is to make sure that those assessments are increasing and being set to meet the needs of the association.
Perfect. So we're gonna get to the question and answer section here in just a second. So the Association Essential Series is gonna continue on August 24th with our reserve, as we mentioned earlier. So we're really looking forward to you guys attending and being involved in that. We'll go ahead and dive into this question and answer section. Looks like we've got a few things that are coming in still. So let's start at the top, Neil, and we'll work our way down.
Yeah, so I think one of the first questions was about having an accountant manage the books versus basic accounting from an HOA. That's going to depend and vary from association to association. If your books are pretty relatively simple, it is just bookkeeping, right? That's what's happening. You're tracking the expenses, you're making sure that they're being accounted for correctly. But there's 100% value in having an accountant perform various levels of an audit, be that a review, a compilation, or a full-blown audit. And some of your association documents may require a periodic audit of those financials. So that would be our recommendation there. One of the next ones after that was about insurance payments. Are they debited to prepaid and automatically amortized to expense on a monthly basis? So that's going to depend on how your insurance payment is made and how it is billed from the insurance company. So a lot of times insurance companies will give you a pretty significant discount if you pay lump sum the entire annual premium right up front. So that can be showed as a prepayment. But most associations, for budget purposes, because they don't have sometimes $100,000, $200,000 to take care of that right up front, they choose to finance it and pay it monthly.
And the finance option isn't that expensive. I know that earthquake and a property insurance policy, they're pretty hefty. And I had an association, as Neil said, that was about 150,000 a year. That was a big hit. Now their budget was accommodating of that, but they decided to go with the monthly payments because they didn't want to have a giant surplus of money coming into a month and then have nothing after that. They felt like it would just be easier for them. But again, that it depends on how you're being billed for it. All right, next question. All right, as a source, an income source, interest from assessments was indicated. Are earnings from reserve funds required to stay with the reserves versus operations? So if you can get enough interest to make something worthwhile, I guess you could really put that in either account, but they tend to just stay in the account they're in. Even CDs aren't getting a good enough rate of return to really do that much. And honestly, if you were getting a large enough return into your reserve account, it would impact the operating budget in the sense that you wouldn't have to contribute as much due to the interest that you're actually receiving. So there's a toss up, and it's something that you need to analyze with your reserve analyst and make sure that you're projecting your expenses with that interest, because it should calculate that interest in the reserve study.
And tying into that, somebody asked what investments are available to HOAs besides CDs. So money market is really common. You can get into investing into various treasury bills, but those are difficult to manage. But definitely something that is an option. Really, you're going for something that can't lose money. Putting an investment into the stock market is, as fun as that may sound, or the cryptocurrency craze that's been going on. Well, crypto took a 50% dive over the last couple of months. You don't want to do that with your association savings. Then right after that, must a collection policy be written, or can it be historically consistent? Our recommendation is written. Written policy is going to protect you and help maintain that historical consistency a lot better than just, oh, we've always done it this way. So the webinar portion, another question, is there an option to ask questions verbally? The webinar function does not allow for that, so they do need to be typed.
Bill, that's a really good question. Bill's question is, we don't think we have the right categories for our operating budget or structure for our reserve projects. So there are examples of budgets out there that we can review. We're happy to try and tailor it to what you need. If you can tell us the categories that you think you need, we're happy to adjust for that as well. We also do have other budgets, right? We manage other communities, but we have a set of general ledger codes that we could try to make match better to your association as well.
One of the other questions that came in, if the operating budget doesn't cover expenses in a given year, can funds from the reserve account be used? So they can be used with a vote of the ownership for a non-reserve item. And our recommendation for associations that are regularly running into that kind of problem, of course, increase your assessments. You can also have additional savings accounts set aside for when you do have those shortfalls and cash flow does become an issue. But if you're going to be borrowing from your reserve account and owners have voted that that's what they'd like to do, we recommend getting that repaid as quickly as possible. So that's, again, going to ultimately lead to an increase in monthly assessments.
There's a question that came in, does an investment account need to be FDI insured? It is definitely recommended and highly encouraged, but I don't think that there's any actual requirement that it is. I would say you're foolhardy if you didn't. Investment, thank you. Savings accounts that are not reserve accounts. I think that
one just came in from Justin. On the topic of placing funds in money market accounts, CDs, etc. What about high yield savings account? Sure. And some associations do have enough funds to be put into those accounts. They typically have minimum balances. But if you've got some of those minimum balances, those are absolutely an option. So a recap on regular assessment increases versus special assessment. I think that that case of the Florida condo that collapsed is really a great case study that we can look at. It's a tragedy and we're devastated of the situation that caused that. But the quote from that reserve specialist, deterioration is a part of life and we need to be prepared for that. So regularly increasing your assessments is a best practice to make sure that you're taking care of the things. Now there are associations, there may be a PUD, right? They're just single family homes and all they maintain is a park strip or something like that. Fine, that it may not be necessary to increase your assessment in that case. But if you're an association that is maintaining the exterior of your buildings, you need to be regularly evaluating the cost of maintaining those and perform the maintenance. Don't just set money aside to set money aside. Take care of the maintenance as that comes due as well.
I had associations all the time that would build up a nest egg and then they were scared to spend it. The whole point was to finally take care of those components that you've been saving for. So they would kind of drag their feet to do the things that they needed to do. And I had an association that had the money that decided to wait on putting a cap on a wall. The coping had come off, and then afterwards rain fell. It was a brick wall. The mortar had swelled up and the wall fell on someone's car. That's a minor example of the same exact thing, right? Don't sit on the money. There's no reason. You need to take care of the things that you need to take care of. Use that tool, the reserve study, to help you do that. And walk the property, look at those items on that list and really make sure, does that need to be fixed? Right? Seal coat was done 5 years ago. It's gone already. Yeah, definitely has to be fixed. Or hey, we used a product that lasts 5 years. Holy cow, this is awesome. Maybe it doesn't need to be done this year. Things to think about.
Yeah, absolutely. So then the next part of that question is the large special assessments. I think to reiterate with that, special assessments need to be for something special, something that's out of the ordinary, something that you couldn't plan for or couldn't foresee. A roof failing after 20 years isn't something special. That is something that is known. It's something that should be planned for. Now, if you understand, right, you're underfunded, your reserve fund is not where it needs to be, you do not have the money set aside, then a special assessment could be appropriate for that and say, hey, look, we've got 10 more years on these roofs. Let's set aside a chunk of money right now so that then we can just make those incremental adjustments as we go. That would be appropriate. One of the questions, what about paying taxes on high yield and other investment accounts? Hey, look, high yield accounts are still incredibly low interest rates right now. There might be some tax implications if you've got quite a sizable amount that you are investing in those, but it's pretty minimal. So Douglas, you had a question about getting together to meet. We can absolutely do that. Email your manager and we can set that up. Then
did we get the taxes on high yield account and other investment accounts?
Yeah, the likelihood that you're going to make enough interest to actually have to pay taxes is pretty small. But hey, maybe you are one of those lucky associations that does in fact have a very healthy reserve account. So maybe you'll have to pay taxes on those. It's going to depend on what the amount is that comes through.
Right. I had a community that had laddered CDs. They had about 2 million that was spread out over about 20 years. And they would legitimately get decent amounts of interest on some of the older CDs because the interest rate was better when they started them. But man, that later stuff, they didn't get such good returns. But they did end up having to pay taxes. We can definitely use the interest that comes in as an offset to some of the other expenses in the community, which could help reduce that amount of tax burden. But 35% of interest taxed by federal and in the state of Utah. So it's a hefty chunk. Other questions? Anybody that we missed? Sorry, the chat box is hard.
The Zoom chat box is my favorite, where it just keeps on adding to the bottom and they seem to get out of order for us real quick. But we do very much appreciate everybody who attended today. This has been a great conversation and a great discussion. A couple of people have asked for kind of some special meetings to go over this. We're happy to do that. All of the managers at FCS are able to answer these questions as well, to help make sure that you understand your association's finance. And then new question, is there any historical analysis of impact on property value by higher HOA fee versus low special assessment versus, sorry, more chats come through and lost this for me, versus lower HOA fee and higher special assessment? There is some analysis of that. That would be available on CAI's website. Ryan, do you want to throw that into chat? In Utah, let's be real honest, we're pretty new to the HOA game. So this is more of a new phenomena that owners are paying attention to these these reserve analysis. But it is absolutely something that people are starting to pay attention to. and be aware of. Keith asked, can you have a seminar on reading financial statements? We're actually getting ready to plan our calendar for next year, so we will absolutely bring that up. That probably would be a pretty good meeting, but your manager really would be a great resource to have them go through that. And we're happy to attend that meeting to make sure that everything's clear. Tim asked, do budgets ever show each owner how their assessments are spent? One of the things that we like to do is a budget comparison that we prepare for the annual meetings. And that shows on a budget, just the year total, what that breakdown looks like per owner per month, how much of that assessment goes to those reserves. And those are really effective and really helpful for when you're having a conversation about a budget increase. Insurance is a large portion of your budget. Landscaping and snow removal is a large portion of your budget, and the saving for reserves. Those are typically your three largest expenses on that budget. And last question, we'll see, Bill. I'll believe it when I see it. Yeah, these are going to be posted on that website. Again, that's HOALiving.com/AES. You look under training, and then all of the past recordings are going to be there. So this one will be up, usually takes a couple of days, but then we get that posted up there. So you'll be able to review it. Your other board members can look and see that. Oh, I just got a chat from our marketing specialist. They're actually going to have it up later today. They're way more efficient than me. There's also going to be updates on social media. We'll blast that out on Facebook and Instagram and Twitter and let everybody know that that's available to see.
Perfect. Any other questions? I'm writing down the people I need to get back to. If you want to get in touch with me, you can. I know Neil's going to just love that I'm sending out my email, but I really do want you guys to feel like somebody's available to reach out to you and talk to us. And so feel free to reach out if you have questions outside of this seminar. You want to reach out and just talk. I know that a few of you have asked for that, so we definitely want to. So Douglas, thank you. Yes, I do have your info here. I'm gonna write your email down though, just in case.
Tim just asked, are lots of folks saving money in water because of the drought? A little bit. We're seeing that we're getting lots of notices from various cities that utility costs are going up because there's no water. There's no water to use. But yeah, it can be a little bit of a savings, maybe some savings on landscaping because they're not having to maintain as much. Weeds aren't growing, hopefully, as much because there's less water going on them. All right. Thank you all so much. Again, reminder of our next Association Essentials series that is going to be next month on August 24th. We're going to be doing a deep dive into reserve studies. And that will be great. Thank you all for joining us.
All right, and just threw that in chat. I'm going to leave this open for just a second longer. Sorry. So if you do need it, feel free to copy it. I thought I sent it to everybody. Zoom makes it so nice to not send it to everybody, but I fixed it. Sorry. I apparently sent it to one person and then I sent it to just us. So this time you should have all seen it. But look forward to talking to you guys and seeing how we can help. Again, thank you for attending. And we wish you all the best. Get ready for budget season. Take care.